Good afternoon, and welcome to Deposit Strategies for today's economic environment. Banks need deposit pricing strategies right now that win and retain franchise-building customers, but that don't inhibit their future growth and profitability. Learn about how your bank can address customer concerns about safety and nurture high-value relationships now, while retaining needed funding flexibility in this volatile economic environment. Thank you for joining us. I'm Kia Haslett, Managing Editor at Bank Director. I work with other members of the editorial team to produce our online and magazine content. My areas of focus include bank accounting policy, operations, strategies, and trends in M&A. This webinar is brought to you by both Bank Director and IntraFi, an information resource to the financial community since 1991. Bank Director focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. A trusted partner to nearly 3,000 financial institutions, IntraFi provides solutions designed to help your bank grow profitability and increase franchise value. The company's innovative services can help your bank attract and maintain valuable customer relationships, grow reciprocal deposits, manage its balance sheet, diversify funding, and reduce collateralization. Before we get started, let me share just a few things to keep in mind. First off, don't worry, we can't hear you. You have joined the webinar in listen-only mode. We recommend that you click on the slide bar at the bottom of the screen to adjust between presenters and the presentation. If you have any questions for our speakers, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation. Once our presenters have finished with their talking points, we'll have a Q&A where those questions will be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note those using the moderator chat feature on the right-hand side of your screen, and we'll do our best to take care of it. Regarding our polls, those will also appear in the sidebar near the Q&A button. When you've selected your answer, just hit the vote button to submit your response. Finally, the opinions expressed in this webinar are those of the individual speaker only and do not necessarily reflect the opinions of the other speakers or of the entities with which they are associated. On that note, let me share a little bit about our speakers today. Chris Ely serves as the Southern Texas Managing Director for IntraFi and works out of the Houston area. Chris has 11 years of experience in banking and finance, with insight in funding and liquidity management for banks. Prior to joining IntraFi over 10 years ago, Chris worked at Morgan Stanley in listed derivative operations. He earned his bachelor's in economics from the University of North Carolina at Greensboro and his MBA from the University of North Texas. Our second speaker today is Steve Kenner. Steve is the Senior Managing Director at IntraFi, where he is responsible for directing sales. Steve has more than 27 years of banking industry experience. Prior to joining IntraFi, Steve was SVP of Sales and Marketing at the Federal Home Loan Bank of Des Moines. He also spent time as the president of the Financial Services Division at Oswald Financial. Earlier in his career, he was Managing Director and SVP of Asset Management at KeyCorp. Steve and Chris, please take it away.
Thank you very much, Kia. Hey, everyone, thank you for attending today. We're thrilled that you're spending this time with us this afternoon. And thank you, a special thank you to Bank Director for hosting this session along with us. On behalf of all of us at IntraFi, one of the things that we get asked most often as we travel around the country working with our 3,000 plus member banks is what are other banks doing? What strategies are other banks deploying to help them grow their banks, manage their balance sheets, and all of the things that Kia just mentioned and that Chris and I will mention in the coming slides. That's what we're here today for. We're going to share those deposit strategies and what's working in today's economic environment. You can get a little inside look at your peers as we go through the next few slides. So Chris, let's go to the next slide and we'll spend a moment talking about IntraFi. So as mentioned, we work with some 3,000 banks around the country and we've now crossed through that threshold. It's a broad reach of banks across the country. 2,500 of those are community banks. We work with a lot of socially responsible financial institutions. We work with a lot of African American and Native American and Asian banks and Hispanic banks and green banks and women-owned banks. And we're just passionate about this space, as you might imagine. And some 20-some years ago, we invented the concept of reciprocal deposits. Today's agenda, We're going to look at the current market conditions briefly, but really focus on deposit strategies because I think that's what you're here for today, and that's certainly what makes the most sense. So let's start with the current market conditions. You'll see it right here, the deposit competition is certainly intensifying. It's coming from all angles. Deposit and bank safety is certainly top of mind, and these headlines to the right side of your screen are just, I'm sure, very, very familiar to you. You know, banks borrow unsecured cash at record clips. The whole SVB Signature Bank thing, of course, yes, over the weekend, and we certainly had the First Republic event. So a lot of noise, a lot of confusion in the market, but we also know there's a lot of strategies that are sound and that make sense, and they certainly deliver to the bank's bottom line as well as benefiting the customers. Chris, let's talk about a banker's perspective, if you would.
Yes, thank you, Steve. 1 second. Right, so in addition to the headlines and all the conversations that we get to have on a regular basis with bankers, we also conduct a quarterly executive survey where we look at direct feedback to specific questions that we ask quarterly. And we will see in the coming weeks if the recent bank failures increase the possibility of a recession, increase the possibility of a hard landing for the economy, and or worsen the already intensifying liquidity crunch. But what we're looking at here is the most recent results of those surveys, and it showed that 66% of executive bankers believe the U.S. economy is headed towards a hard landing. 70% think a recession is possible this year, and 88% reported deposit competition getting tougher. And folks, what's important to understand is this was all collected before the recent bank failures, and we're still seeing those unfold. So we were on fairly uncertain ground before, headed into this mess, and those things have certainly intensified as well. So let's take a look at actual deposit strategies for your bank today. Second. So right now is really the time to take action. You can rethink priorities for not just now, but also in the future, particularly around protecting large customer relationships. So when you think about this, think about building loyalty and trust right now. Just over this past weekend, and still unfolding this week, we saw another bank fall into trouble. And this is the time to address customer concerns before they have anything to worry about, before they bring it up to you. You can also use this time to actually grow core deposits and or, in many cases, replace collateralized deposits while doing so. And finally, you can proactively manage your liquidity. As we've seen in the past few years in particular, liquidity management plays a vital role in changing liquidity environments. We have seen during the past few years at least, the liquidity pendulum really swing drastically in one direction or the other. So as we go, these are the kind of the 5 things that we're going to talk about today. And let's start first with rethinking deposit gathering. This recent banking crisis has caused bankers to refocus their efforts on maintaining and growing deposits and high-value relationships. In fact, we've actually seen our most successful network members having some things in common with regards to their approach on how to do this. The first thing we've noticed is that many banks are now naming a chief deposit officer. So the CDO acts as the expert and really the point person for product offerings, processes, and outreach efforts, all related to deposit gathering. Essentially, they are tasked with that all important point of bringing deposits into the bank and funding the bank with core money. They're also members of the ALCO committee, which gives them a seat at the table where important strategic conversations are being had. So this has become a very important role that we've seen a lot of successful banks that we work with implementing. We're also seeing banks training every employee on the bank deposit programs. And that doesn't mean that every single person needs to be a subject matter expert, but rather that every single person, at least who comes in contact with a depositor, knows enough about the product offerings that the bank has to be able to identify potential deposit gathering opportunities. They need to know what the bank has to offer, how to identify opportunities, and then can escalate those conversations internally to the appropriate subject matter experts. The third item listed here is analyzing customer data to fine-tune offerings and outreach plans in order to build loyal, high-value customer bases. For example, you can run a query of customers that have roughly, let's say, $250,000 on deposit. Those customers might have additional deposits elsewhere, but are maintaining balances below the FDIC coverage level on purpose so that they remain within that FDIC coverage window. That poses an opportunity for you to win additional wallet share from that segment of customers, but you have to look at the data in order to recognize that opportunity. Every bank out there can run a query, look at this customer group, and build a target plan with that audience to do some outreach and hopefully drive more deposits into the bank. Finally, the last point, we're also seeing banks pricing strategically based on the value that that deposit brings to the bank. In other words, you might have to pay a premium for deposit relationships, but those should be relationships that add value beyond a normal deposit. So conversely, also, we don't want to be overpaying for relationships that don't add significant value. It's a little bit of a different take on pricing that allows bankers to consider the overall benefit of the deposit relationship without overpaying for those that don't. So let's keep moving on with some more points here. Not surprisingly, during the recent spat of rapid rate increases by the Fed, many of your peers have been raising. Other banks look at the type of the deposit, the size of the deposit, maybe the customer type, and they raise rates more selectively. According to our survey at the end of 2022, many banks had begun to raise their rates to retain existing deposits and to attract additional funding. At least 94% of bank executives surveyed reporting increasing rates on deposits in some manner. So the vast majority of banks increase rates in some way, shape, or form. 36% hiked rates on all deposits, 18% according to the customer type, 16% only on time deposits, 12% on deposit size, and then finally another 12% increased rates when customers were ready to leave. And we're still expecting another 25 basis point increase from the Fed at their next meeting, which is actually tomorrow. And deposit pricing continues to be a topic that most banks are dealing with, but these numbers give you a sense for what other bankers are doing right now. Now, not surprisingly, I'm going to update my slide here. Now, what I want to invite you to do now is to respond to a polling question. This will be the first of a few questions that we're going to do. And you can answer this question in the polling feature within this webinar. So we'd love for everyone to participate here. The question is, have recent bank failures and concerns about safety caused your bank to pause planned rate increases as your bank is betting that the Fed increases will slow or stop? Has your bank sped up rate increases in a bid to keep your customers? Or has your bank, or it hasn't had an effect on your deposit pricing strategy? So there's three selections there. I'll give you a second to think about it, but the question is, have recent bank failures and concerns about safety caused your banks to do the following? And I think we have, let's see, maybe we'll just give it a second for the results to roll in. think I might know the answer, but we'll see what the distribution looks like. All right. So results are still rolling in, and thank you for those who participated. And it looks like it's fairly evenly split, but 54% currently are saying that the recent bank failures and concerns about safety has caused your bank to speed up rate increases in a bid to keep your customers. Trailing behind that by not too much, actually, 46% said it hasn't had an effect on our deposit pricing strategy. So that's interesting. That's kind of what I would have expected. But this gives you yet another data point to understand about your peers, what they're doing, and that's why we're here today, just to get more information. All right. So as you know, and this probably goes without saying, but banking is very much so a relationship-based business. You bankers are an integral force that helps your respective communities to thrive. Communities need you. They need their bankers. And you also need local money to stay in your bank. That's why it's important to build loyal relationships that are going to help your bank accomplish its very important mission. IntraFi is proud to provide banks with tools that enable each member institution to offer multi-million-dollar FDIC coverage on CDs, DDA, and MMDA accounts. That means, in very basic terms, that a single member bank such as your own can access the FDIC coverage capacity of thousands of banks working together. And that's what we call in-house, we call that the power of many. That makes your bank stronger. It makes each of your community bank peers stronger. It makes your whole banking industry stronger as well. So let's look at how that actually works. So here at IntraFi, and there are other providers of this as well, but we'll just use IntraFi's terms as an example. We offer two very similar products that expand FDIC coverage. The first is CDARS. That stands for Certificate of Deposit Account Registry Service. That service allows you to offer up to $50 million of FDIC coverage on CDs. There is a sister product called ICS. It stands for IntraFi Cash Service. That very similarly accomplishes the same thing. So it's multi-million-dollar FDIC coverage, but rather than CDs, it's on DDA and or MMDA accounts. And by the term customer in this case, I mean your customer, as in the end depositor. So again, that's $50 million of coverage for CDs, $150 million of coverage for DDA and MMDA accounts. And this graphic here allows you to see the very simple flow of funds that makes this possible. Basically, customer deposits money at your bank. You are then what's called the relationship institution, who is placing money on their behalf through IntraFi's network of banks. Without ever touching your customer's money, IntraFi provides the technology required to place your customer's large deposit into multiple banks in increments, very importantly, under the $250,000 FDIC coverage limit. So that allows your customer to maintain the relationship with you, but use a provider such as IntraFi to spread their deposit out amongst multiple banks in a very simple, seamless, convenient way so that they can access higher FDIC coverage limits. That's we can show this and represent it in this very simple illustration right here on this page. So that is basically what we do and how the funds move. Very importantly, and because the customer is working directly through you, you get to maintain the banking relationship with your client. They get to work with a bank that they know and trust, which is yours. Your customer's information is kept confidential. throughout this entire process as well. So what that means specifically is that none of the underlying banks know any confidential information about your customer. The way that's possible is by having the Bank of New York Mellon, who's the largest custodian bank in the world, handling the record keeping and the trail of money for all the banks in the network. So your customer simply receives a monthly statement, which will show which banks are insuring their deposit. And additionally, the ICS program also provides a website for your customer to log in and check their ICS account information anytime that they choose. So your customer has full transparency of which banks are insuring their deposit, and they can even exclude banks for any reason that they choose to not be eligible to hold their deposit. So they have very much transparency and control in that manner. And because you are the relationship institution, you are also able to price your customer's deposit anywhere that you like. So your bank controls its own deposit pricing. The interest that you offer your customer is the interest that your bank will pay. So another part of what IntraFi does, what the system does, is it calculates all the rate differentials kind of in the network flowing through the transaction, and we neutralize the effect of those rate differentials for each individual bank. So there's accounting and GL entries involved, but basically what it means at the end of the day is that your bank continues to maintain control of its own customer pricing, independent of what any other banks out there decide to pay their customer. So really, really important that all of this boils down to you and your customer maintaining just as tight and close of a relationship as you would, without using a product like this. You're just using a network just to spread the money out across banks, but the relationship is still kept in-house. Very, very important. Right, next slide. So we have another polling question, and we'll do this the same way as the previous. I invite you to participate in these, and we'll just kind of go through the results as they come in so that you have a moment to think about it. I'll read it so we're all looking at this together. How important is your bank's commitment to customer service and your bank's reputation and brand? So how important is your bank's commitment to customer service and your bank's reputation and brand? So there's three answers here. Is it very important? We market ourselves as customer focused and attract and retain customers based on our reputation for service. That would be selection A. Selection B, is it somewhat important? We consider it table stakes, but it isn't a key part of our value proposition. Or is it option C, it is not important, customers value our bank for other factors and are neutral about their service experience? Let's see what results went in. All right, second. That is, I knew it would be a landslide for the first one, but it is more than a landslide. 100% of you say it is very important. We market ourselves as customer focused and attract and retain customers based on our reputation for service. So 100%. I'd hate to be, if there was one person out there thinking about going the other direction, you made the right choice. Very important, probably something we knew anyway, but this is what has made community banking so important and so strong, and it's really something that I know the bankers and the clients I talk to hang their hat on this very point, which is the customer service and the commitment to your clients, the commitment to doing things that are right for your clients. That shined very, very strongly during PPP and during COVID. You bankers, you community bankers were there to support your people, support your customers, and that was really a proud moment for everyone. So what great to see those results. So back to the model that we were discussing. this model really reinforces your commitment to your customers, which ties into the previous survey question. By offering access to millions of FDIC coverage, your bank can demonstrate that it understands what's important to its customers, particularly right now. And there's a big emphasis on right now. The window is open when people are thinking about this. It's in the news. There's a lot of concern around the industry in general. This is the moment to prove your commitment once again, as you have before, and continue that incredible track record that community bankers have. So you can be proactive in communicating this value proposition and satisfying a concern that many customers are thinking, but few want to voice. They might be thinking, are my deposits protected? Are my deposits safe? With Cedars, ICS, similar type of products, the answer is yes. And in times like these, which are particularly challenging times, that gives you the opportunity to build loyal, deep customer relationships. These challenging times are the windows to do that, because you have the chance now to lead your clients through this time, provide them with safety, provide them with security, answer that question that's probably kind of deep inside that they're feeling some concern about, quite frankly. So this is a window of time, and I encourage you to jump on the opportunity. And it is also an opportunity not only to deepen existing relationships, but to look to grow new ones. Safety-conscious customers that are a fit for Cedars and ICS are typically large dollar, low cost, and local. But they might be banking elsewhere. And a lot of times we get asked, how do I identify that? What do I look for? So we're going to give you 4 common scenarios to look for. So the first is, do you know customers who are banking at a large non-local bank that is perceived to be too big to fail? If the driver of that relationship is to rely on too big to fail status as a form of safety, then there's an underlying customer need there that could be potentially better satisfied by IntraFi Network or Cedars and ICS. So that right there is an opportunity to win new customers that I would bet the vast majority of people on this call can think of at least 1 or 2 opportunities that are out there right now based on that scenario. Another one to think about, number 2, do you know customers who are banking with multiple banks while keeping balances at each bank under $250,000? What if you offered them a product that could bring their relationship in under one roof and use the service to do that much more efficiently? For them, that would mean no more multiple statements, no more multiple rate negotiations, no more trying to juggle multiple banking relationships. They can work through you, but enjoy the safety and security of many. Third one, do you know customers who use a single bank but establish accounts under multiple insurable capacities? Once again, Cedars and ICS can satisfy that need in a much easier way, not only for your customer, but for the bank as well. And the last, finally, do you know customers who use a single bank while requiring that bank to collateralize the deposit? And of course you do. I'm sure all of us do. But collateralized deposits require tracking. It requires monitoring. It ties up the bank's securities portfolio, which reduces overall liquidity. Cedars and ICS are an approved way to protect customer funds in lieu of collateralizing deposits. So I've just given you 4 very, very common things to look for to open up new customer opportunities. And there's really no better time than now to identify these target opportunities and act on them right now in this environment. You might be wondering more specifically, though, what type of customers these can be. So these customer opportunities can come about from pretty much any type of customer, but typically we see businesses, government entities, nonprofits, and some other classes as well using CDARS and ICS. Really, it's completely up to your bank's market and the types of customers that you choose to service. For example, there are many business banks who look to corporations, mid-sized companies, small businesses, and they use CDARS and ICS to attract those type of relationships. We also have many banks that focus CDARS and ICS on their public fund business. The point of that mainly is so that they can reduce and alleviate the need to pledge collateral. But there really is no wrong answer here. Every bank we work with is different. Every bank sees opportunities with safety-conscious customers through their own unique experience and their own unique lens. Consider some of the customer types you see here as perhaps a good foundation for just customers to think about. A lot of times this is a slide that people refer to after the presentation as you're flipping through, trying to go through your thoughts. This is one often that people will just print out and keep by their desk or keep with them to have conversations internally about perhaps a target group to go after. What we have seen, and on this slide, is that balances associated with ICS and CDARS tend to be large and less price sensitive, thereby lowering your customer acquisition cost and providing more cross-selling opportunities. The reason is because if sold correctly and if the conversations go correctly, you're not attracting this money based on rate alone. That's going to be a losing game in the long run. You never are always going to be the highest paying bank, probably shouldn't be. So you have to equip yourself with something else to offer. And you've already earned the respect in your communities by being community bankers. And paired with products that offer safety, you can offer safety as well. So you can attract, in other words, you can attract less price sensitive customers because they're banking with you because they want to be at a community bank, and they are safe. Their deposit is safe at that bank because it's in CDARS and ICS under the FDIC coverage limit. So community bank, going to use these deposits to grow and build and do right by the community. Bankers that I know and trust, product that's safe. That is the three-way messaging that tends to be pretty compelling for risk-sensitive customers. And we also see by the numbers that these customers tend to be very, very sticky. With CDARS, the reinvestment rate is about 80%. And with ICS, banks typically see less than 3% of reciprocal accounts liquidated in any given month. So these are, in fact, very sticky deposits. Here we see that businesses make up about 48% of ICS deposits. Public entities make up about 27% of the ICS deposits. And on the CD side, it's a bit more evenly distributed amongst businesses, public funds, individuals, and nonprofits, all roughly about a quarter of the pie apiece. So this just gives you a feel for generally where other banks have had success. And the benefit to the customer starts first and foremost with peace of mind. So they get multi-million-dollar FDIC coverage through a single bank of their choice. They also have the potential to earn an attractive return, especially when compared to treasuries and money market mutual funds. That depends on what your bank is willing to pay, but the opportunity is certainly there. Convenience is another really big factor as well. CDARS and ICS eliminate having to track collateral, having to footnote uninsured deposits on financial statements, having to manage multiple statements from multiple banks. It is just at the end of the day a much more convenient way to manage large deposits. So there's safety, potential to earn an attractive return, convenience, but the last one, which is personally my favorite, is there is a significant benefit to keeping their money local at a community bank where it can benefit the community. This is essentially your purpose and your advantage as a community banker. Clients should understand and value the fact that their deposit, if kept in their community, goes towards developing their community. It helps people get mortgages. It helps businesses get their start. It helps your community and their community to grow. And this can be a particularly good time to remind clients of how important community banks are to this country. It's very difficult to see some of these larger regional banks fall into trouble and some of them go down. This is a very important time to remind people what community banking is and what your bank does for the community. So peace of mind, attractive return, convenience, and supporting their community, for very important and compelling value propositions to customers. All right. So with ICS and CDARS, your bank can receive reciprocal deposits, which are on-balance sheet funding that your bank can use to grow its franchise value. Or if it's flush with cash, it can sell the excess funds to banks that need funding and earn fee income. We call that the one-way sell feature. So with customer money, you have the option to do reciprocal, which is on balance sheet, or one-way sell, which is off balance sheet. And there is a third model of this equation, which is wholesale funding. That is the one-way buy side. So what we're looking at right now is the reciprocal side, which is it enables you to grow core deposits. It is really important or advantageous to note that legislation was passed in 2018 that allowed most reciprocal deposits to now be counted as core. So your bank can use a reciprocal program, not with the detriment of getting tagged as having a bunch of brokered deposits now. We have seen this change in legislation have quite a change on balances overall. So you can see in this graph that reciprocal deposits grew from about 62 billion in 2018 to where it is today, which is well over 156 billion post-legislation. So banks were already relying on reciprocal deposits as an important funding tool, but with the brokered deposit classification removed, it provided much more room for banks to grow without being penalized for having too much brokered. And relative to many other options, reciprocal deposits tend to be much more stable. So they can help your bank to reduce collateralization and tracking costs. It can help banks to spread customer acquisition and maintenance cost over a larger customer base and to offer greater balance sheet flexibility. And all of which, at the end of the day, increase your ROA and your ROE. And it's probably no surprise to anybody that most banks are looking for deposits right now, and especially with wholesale funding costs rising, reciprocal deposit funding can be a more cost-attractive way to do that. Even if you have to pay an exception rate for certain big customers, that's still going to be less than what it would cost on the wholesale market. And that's why reciprocal deposits continue to grow and continue to be a more integral funding source for banks all over. Another opportunity for banks is to help strengthen their balance sheet by replacing collateralized deposits. Often a recommended first step in replacing collateralized deposits is to identify your bank's current repo customers and current repo balances and move those over into, for example, an ICS program. You might have public fund customers that you're collateralizing for currently. That's another great place to start. Actually, many banks that we work with start off focusing on public funds, focusing on getting away from collateralization and moving them into CDARS and ICS, and then they eventually find success with that and expand the product offering to other customer types, such as businesses, large retail clients, whatever subset works for you. Very important to note that all 50 states have laws that enable public entities to protect taxpayer funds using ICS and CDARS. All 50 states, and there are billions of dollars of public fund money already in the system today. Each of those public funds, as you know, underwent their own due diligence, their own review process, and independently deemed CDARS and ICS appropriate for their usage. So the public fund codes allow, and based on the public fund's own assessment, typically are fine with these products as well. So I started mentioning earlier, I got a little ahead of myself, but the IntraFi products can be tailored to and adapted to your bank's evolving needs. That's the way we accomplish that is that CDARS and ICS have three transaction styles. There's the reciprocal transaction, which is shown in the first image on the left-hand side of the slide. That's where you place customer money in our network, your bank receives matching funds back on your books. So if you send us $1 million, we place it with insured institutions, send your bank a matching $1 million right back in return. That accomplishes the FDIC coverage aspect for the customer, but keeps the value of the funds on your books. In some cases, though, you might not want the deposit back in return. So if you are a more liquid bank, or let's say the deposit is too big for your balance sheet, or perhaps it's too volatile for your balance sheet. There are a lot of different reasons why banks sometimes prefer not to hold certain deposits on their books. So if that's the case, you can do the one-way sell model. That allows you to still have the customer receive multi-million-dollar FDIC coverage, but you're simply opting not to receive matching funds back on your books. We'll go into an example in the next slide, but I just want to leave it at that to start. The third model shown on the right-hand side is what we call one-way buy, but it's basically for those banks who want to receive funds but don't have their own customer to do this with. So if you just want to pull money out of the network, you would do that on a wholesale funding basis. That is a brokered deposit. That's a wholesale brokered deposit, but that allows you to bring in money for contingency funding purposes, just for overall liquidity management. It's while not the only tool to rely on, an important tool of any bank's balance sheet. So reciprocal, on-balance sheet customer money, one-way sell, off-balance sheet customer money, one-way buy, wholesale funding. Those are the three transaction models that allow you to manage your liquidity. And here we have an example that goes a bit deeper into the one-way sell or the off-balance sheet model. This is something sometimes people pass over thinking about this because they know that their bank is in a position where it wants to grow deposits. But we are still, even today, with the vast majority of banks focused on generating deposits, we're still seeing many banks selectively using the one-way sell model for certain scenarios. That could be, as I mentioned before, a deposit that's too big for your balance sheet, perhaps to protect capital ratios, perhaps to reduce concentration risk, perhaps to reduce volatility. But there is one more that seems to be coming to the surface more and more these days, and that is to be more competitive on pricing. So when you do the one-way sell model, and we're illustrating this example here on the right-hand side, the network offers a gross rate for those one-way sell funds. That gross rate represents what your bank gets paid for the placement. In this example, we're saying the gross rate is 3.75%. That means that's what the network is going to pay your bank. Your bank still gets to price its customer's account wherever it wants to. If you price your customer account below the 3.75 that you're receiving, then you keep that differential, that spread essentially, as fee income for your bank. So if a customer placed a $5 million deposit, the network is paying $375. Let's say you scrape 1% as fee income for yourself. That means your bank just made $50,000 basically to key in a transaction online. A little bit more to it than that maybe, but that's how the economics of it break down. And the rates are frankly well above 3.75 right now, and about to get another Fed rate hike tomorrow, most likely. So this can give you an opportunity to be more competitive selectively without really incurring that cost on your own balance sheet. This slide looks at wholesale funding, at least IntraFi's wholesale funding deposits. From our own experience, we've seen steady, stable growth in wholesale funding across all different economic environments. Wholesale funding, even today, remains, actually especially today, remains a frequently used way to fill overnight, short-term, and long-term funding needs. And as you can see by this graph, our wholesale funding programs increased by about $100 billion since 2020. While it's an important tool for contingency funding and as a general source of liquidity, wholesale funding pricing has, quite frankly, increased quite a bit. As demand goes up, inevitably that's going to drive pricing a bit higher as well. Let's talk about the customer experience with FDIC insured deposit services. I'll remind you again that the customer experience is driven through you. So we provide support during the selling process, but once they've agreed to sign up, each customer signs a deposit placement agreement and a custodial agreement. IntraFi provides that agreement to its member banks, and the banks get that signed with their own customer. The customer then deposits money at an internal bank transaction account. Therefore, the money doesn't go directly into CDARS and ICS. It has to flow through your bank first. In the third step, the funds are placed into the network. So your customer might elect to do CDs. If that's the case, then they're doing CDARS. If they elect for a DDA or an MMDA account, then they would be an ICS. The process is mostly the same regardless of which product they use. They do receive confirmation in the fourth step. So with CDARS, they get a new account notice at the end of the week. For ICS, there's an online portal where they can log in 24/7 and confirm that those placements are made. And then finally, for the last step, for each service, they get one consolidated statement from you, which is generated by IntraFi. So we generate that statement, but it will have your bank's logo, your bank's name, your banker's contact info. We provide it to you, but you are the ones who, generally speaking, provide that to your client. That's in order to keep you always at the forefront of your client relationship. So 5 simple steps. This is basically the process to move funds through. Statements. So in the interest of time, I'm not going to go too deep into this, but they do receive one statement per service. So if they were using both CDARS and ICS, that's 2 statements. If they have multiple ICS accounts, that's all going to be consolidated under one single statement. We try to consolidate the paperwork as much as possible. Remember, one of the selling points here is that they don't have to be receiving 10, 15, 20 statements from all these other underlying banks. So we give a very simple, consolidated breakdown of the money that's placed in and insured in their CDARS and ICS accounts. Next, we have what we call the depositor control panel. That's our version of your client's view into their balances, deposit withdrawal activity. underlying banks all relating to their ICS account. So here they can log in 24/7, see all the granular breakdown of any information that they would need for reconciliation, reporting, pulling statements, anything to do with the ICS product. Your customer can log in on their own to this website and gather that information that they need. Okay, nearing the end here. So just to recap, let's rethink priorities for now and in the future. And deposit gathering, no doubt, should be top of mind, a top priority right now, given current events. Secure customers' large relationships and build loyalty and trust. Grow core deposits, replace collateralized deposits, and proactively manage liquidity. So if I can summarize the messaging here, it's that this is the time for community banks to offer safety and simplicity, and prove once again what community banking is all about. So we stand by your mission, we offer our services to help, and we very much thank you for your time. And I think we have 9 minutes or so to answer any questions. Kia, I'll maybe open it back up to you.
Hi, Chris. Hi, Steve. Thanks so much for that presentation. We did get a couple of questions that I was wondering if I could throw to you. The first is there an example where Bank A is willing to pay a certain percentage or interest rate using ICS or CDARS to maintain existing or deposits or attract new relationships, but Bank B in the network isn't willing to accept that rate? How does this difference work?
Sure, I can take that one. So the beauty of our system is that each bank prices their own deposit independently of what other banks, how other banks have priced theirs. There is a difference in those interest rates. We simply calculate that difference and true up each bank individually to their cost of funds. So we'll match it closely, as close as you can, but the rates aren't going to be exactly the same. Whatever difference there is there, we calculate it, and it's basically a wash at the end of the day.
Is it required that customers receive those paper statements that you showed, or is there an electronic statement delivery option?
There are different delivery options. So they do need to receive a statement, but that can either be, we have some banks who mail it, we have some banks who actually pay us a small fee to handle it and mail it for them. Also, there are electronic versions available on the depositor control panel, which was one of the later slides. So they can still independently go out to that website on their own, pull those statements so that they have access to that anytime.
Do banks in the network use the one-way sell feature of ICS and CDARS right now in this funding market?
Let me grab that one, Chris. They certainly do, Kia, for a couple of reasons. Think about one-way sell and reciprocal in combination to give a bank synthetic size. You never have to say no to a deposit of any size, regardless of the size of your bank and your concentration limits and so forth, because you can always split the deposit between what stays on balance sheet and what goes off balance sheet. As Chris mentioned, one of the things today, people are controlling their cost of funds by taking the high dollar or high interest rate required deposits off balance sheet using one-way sell and keeping the lower margin funds on balance sheet to keep their cost of funds low, so as low as possible. So yeah, it's been very active on reciprocal and one-way sell, and as Chris mentioned, it's just a great tool with lots of versatility.
So what are bankers' concerns right now? Have you been seeing a lot of pickups since mid-March? Are bank customers, are their customers asking them about increasing deposit insurance coverage?
Right, Chris?
Yes. So this is the world that we live in, right? This is kind of what we do. So most of our conversations are around addressing the concern, the question, just what do I do for clients who are, they're reading the news, they're uncomfortable about the whole situation, not uncomfortable specifically about their own bank, just in general. It is not a good feeling to turn on the news and every single station is talking about, the next bank that's struggling. So most of our conversations are about proactively managing that conversation, having a solution for those clients. We have had many banks join in the past 6 weeks that previously didn't have a very good answer to that question. So that is what we are all hands on deck kind of helping banks address. I know that liquidity as well has been a big factor that a lot of banks are looking at. I touched on our wholesale funding side of the business. That's something as well that is also part of the conversation, because banks want to have every tool available right now to pull that switch and bring more deposits into the bank.
And then finally, what are the first steps for any bank to implement this deposit offering like ICS or CDARS? I know that you showed kind of how it starts, but how can banks get follow up after this webinar?
Yeah, so we love to know who we're working with. So it starts with a conversation, starts with us and the bank getting to know each other. Once bank has deemed once they want to move forward, we basically send paperwork electronically. We use DocuSign. There's 2 signatures. Then we collect some bank information, and that kind of gets the ball rolling. We have a really well-seasoned client services and onboarding group, and they basically handhold and walk each bank through their onboarding process. There's some operational setup, some general ledger setups, but the fun part of it is once we get to the training phase, we do we have different versions but we do an operations training and a sales training. And once we get to the sales training side of things, then we can launch. We can start setting up conversations with customers. We can start really hitting the pavement and getting the wheels turning on this thing. So we've done it literally thousands of times for thousands of banks. We have a pretty streamlined onboarding process, and it's fun each time. It's fun to launch a new bank and get to work with someone new.
Yeah, I think to tag on to what Chris just said, one of the secrets of this company is that there's over 30 of us that have roles similar to Chris and mine, where we spend every day helping banks become successful. Like Chris said, whether it's training the back office, whether it's training the sales forces that are going to go out for the banks and attack a customer basis, or talking to the treasurer or the CFO about how to do wholesale funding. I mean, so the secret, I think, is just the transition from not a vendor, but to being a partner is something that we've transitioned really well as a company. And we feel very strongly, as Chris mentioned, about the community bank's mission. We feel very strongly about helping community banks be successful. And there's 220 of us in aggregate, but 35 or so of us that are focused just on helping banks become successful every single day.
Well, that is all the time we have today. Chris and Steve, thank you so much for joining us for this really important and timely topic. As a reminder to all attendees, you will receive a recorded version of this webinar within 24 hours, and it will also be posted on bankdirector.com. Thank you again to Chris, Steve, and Intrify for co-hosting today's webinar. Thank you to everyone for joining us, and have a great rest of your day.
Have a great day, everyone.
Thank you.